Dear traders from around the world, we're going to cover 3 chapters on the U.S. money supplies making history for the first time since the Great Depression. And it implies a big move in stocks is on the way. Do not ignore it. The U.S. money supply, liquidity and investments. An increase in the money to supply generally means more liquidity in the economy. Valuation multiplies. The stocks are often valued based on future earnings potential. 3, consumer spending. More money in the economy can lead to increased consumer spending for tech companies. Market sentiment. Growing money supply can improve overall market sentiment, leading to increased investment in riskier assets. Inflation and interest rates. Let us not forget the M2 money supply leads to higher inflation. The Federal Reserve might raise interest rates. We know that's not going to happen. We know by understanding these money supplies, you got to know one thing. This money supply hasn't been like this since the Great Depression. Now, let me tell you another thing. About 6 months in advance, liquidity investment, valuation multiples, consumer spending, market sentiment, inflation, interest rates. Understand these dynamics can help you navigate the tech sector more effectively. Are there any specific tech stocks that you want to buy? I can tell you this is just the beginning of our coverage of the money to supply. Chapter 1, based on all of our top end heavy with the money to supply, is at 100-year alerts. It has not been this low in the last 100 years. That usually takes 4 to 6 months. But let me tell you this. Every single time since the 60s, when money supply has shrunk, tech stocks have sold off miserably. What we are going to do is do 3 different parts of how the money supply will affect your investments. Stay tuned, sign up to get the next 3 chapters of the money supply. Chapter 1 is going out now. Chapter 2, 2 and 3 will be coming next.